Now that 2022 is over, let's look at a major mistake that happened here and by most investment managers. Yes, 2022 is expected to be a rough, rocky year for the stock market, but it was also a rough, rocky year for the bond market. That was the part that was unforeseen. Stocks go down, they have those slow years, and you shouldn't cash out because of it. You shouldn't put your money on the sideline. For one, cash was earning zero at the beginning of the year. And two, you don't know when the drops are going to start or be done. And so you're better off with long-term money holding through stock market crashes and corrections. Bonds, however, shocked everybody. Practically nobody, saw that the Fed was going to raise rates so high, so fast. I heard so many people, experts, saying, yep, they can't raise it over 2%. They can't raise it over this, that. And they did. They raised it over to 4%. And that shocked the market, investors, and especially bond owners, because bonds had losses in the double digits in almost every type of bond there is. Some bonds lost 20, 30% last year. Major losses. Now, in hindsight, it's easy to look at it and say, yeah, okay, don't fight the Fed. The Fed's raising rates, get out of the way. But that wasn't so clear when you were actually in it, because it was difficult. I didn't see how severe they were going to tighten until they were close to doing it. I was right there with the market. I didn't have that foresight to say, okay, this is going to get much, much worse. Thankfully, going forward, what they've done is they've raised it to such a level. Yes, they'll probably be raised a couple more times this year in 2023, but this is probably it. They're probably going to stabilize the federal funds rate, which will stabilize the bond market, and it will be at a healthy rate where it's actually earning the average. Even Treasury is earning 3-4+% right now. Corporate bonds have a little more risk. They're going to pay a little bit more. And those are reasonable bond rates to earn, to receive as a bond owner, because you know you're getting that interest payment. So even if the Fed changes the interest rate 0.25%, 0.5%, 1%, you can still, for most bonds, have a positive year, which is good. Your money's going to grow. That's not what happened in 2022, and I wish I saw it clearer ahead of time. But that's a lesson learned. That's experience. That's why you want somebody that's not in their first year as a financial planner. I'm Justin Struble. I'm not a broker.